the MPC met on the 3rd, 4th and 5th of December to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. Consequently, the STF rate under the LAF shall stand adjusted to 5% and the MSF and bank rate to 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for the decisions of the MPC. The MPC noted that the headline inflation has eased significantly and is likely to be softer than the earlier projections. This is primarily on account of the exceptionally benign food prices. Reflecting these favorable conditions, the projections for average headline inflation this year and Q1 next year have been further revised downwards. Core inflation, which had been rising steadily since Q1 last year, eased at the margin in Q2 this year and is expected to remain anchored in the period ahead. So both headline and core inflation are expected to be at or below the 4% mark during the first half of next year. In fact, the underlying inflation pressures are even lower, as the impact of increased prices of precious metals in this inflation number is about 50 basis points. Growth, while remaining resilient, is expected to soften somewhat. Thus, the growth inflation balance, especially the benign inflation outlook on both headline and core, continues to provide the policy space to support the growth momentum. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 5.25%, and the MPC also decided to continue with the neutral stance. Looking ahead, domestic factors such as healthy agricultural prospects, continued impact of GST rationalization, benign inflation, healthy balance sheets of corporates and financial institutions, congenial monetary and financial conditions should continue to support economic activity. Continuing reform initiatives, moreover, would further facilitate growth. On the external front, services exports are likely to remain strong, while merchandise exports face some headwinds. External uncertainties continue to pose downside risks to the outlook, while speedy conclusion of various ongoing trade and investment negotiations which the government is undertaking with various countries and jurisdictions present upside potential. Taking all these factors into consideration, real GDP growth for this year is now projected at 7.3%. This is up by about 0.5% from our earlier projections. Q3 is projected at 7% and Q4 at 6.5%. Real GDP growth for Q1 next year is projected at 6.7% and Q2 next year at 6.8%. The risks are evenly balanced. I will now move to inflation. Headline CPI inflation declined to an all-time low in October 2025. The faster than anticipated decline in inflation was led by correction in food prices, contrary to the usual trend witnessed during the months of September and October. Core inflation CPI remained largely contained in September-October, despite continued price pressures exerted by precious metals. Excluding gold, core inflation moderated to 2.6% in October. Overall, the decline in inflation has become more generalized. Turning to the inflation outlook, food supply prospects have improved on the back of higher kharif production, healthy rabi sowing, adequate reservoir levels, and conducive soil moisture. Barring some metals, international commodity prices are likely to moderate going forward. Overall, inflation is likely to be softer than what was projected in October, mainly on account of the fall in food prices. Considering all these factors, CPI inflation for this year is now projected at 2%, again about 0.6% downwards from our earlier outlook.